guys. So today we're going to be covering chapter 2, which is the financial statement auditing environment. Okay, just to start off, I want to do a quick review of what we learned in chapter 1. So if you remember in chapter 1, we talked about how the demand for auditing arises out of the principal agent problem. So specifically, we have managers versus owners, shareholders. Both parties have conflicting self-interests, and this causes agency problems. All right, now we know there are some, like auditors aren't the only solution. There are some other ways to mitigate this. And so we talked about possibly using incentive contracts and stock options and things like that to try to make managers behave more like owners. So this can be a good solution. However, we know that those incentive contracts options aren't perfect, but because for one example, or they can cause managers to become fixated on more short-term valuation of the company. Basically, they want to maximize their option value, not maximize firm value. All these problems create a demand for independent third-party auditors to come in and be relatively impartial. Third parties working on behalf of the shareholders to ensure that the financial reports of management are accurate. All right, so that being said, that was last time, that was chapter 1. Now we're moving into chapter 2. And today we're going to be talking about role of corporate governance in companies. We'll also be talking about organizations and regulators that affect the public accounting profession. And lastly, we're going to have a segment where we talk about auditing standards and principles that govern audits. I'm going to start off by talking today about corporate governance and a model for business. All right, so hopefully you know from some of your other classes, you probably already talked about this quite a bit, that corporate governance are all the people and things in place, processes and activities. Those are the words I was looking for. All right, so all those things that are in place to ensure that a company's assets are safeguarded and used appropriately. Right? So this can be high level stuff, like we know it's important to have good tone at the top. It could be having a good independent audit committee, a board of directors is in place. So those are all the high level kind of governance environment things, all the way down to the low-level individual process controls. So this would be things like, I have my little example there. We know this guy, we know in the AP process, usually if you're cutting checks over certain threshold amount, we want to have 2 signatures, 2 people approving that purchase. And usually for small routine purchases, yeah, 1 person's signature is fine. Okay. And good corporate governance basically wants to make sure that a company's assets are being used appropriately, employees are making good use of their time. So management isn't doing things like frittering away company resources. We talked last time, using the corporate jet to take dates out. That seems like a random example, but I think the COO of Enron did do that. That was one of his things that he did that was kind of a red flag that, hey, something is not quite right with the tone at the top at this organization. So basically making sure good corporate governance will make sure that managers are making good use of their time, like they're actually managing, they're not spending all day on Facebook, and they're using the entity's resources appropriately in the best interest of those absentee owners, shareholders. So let's look at corporate governance in a chart, and then we can talk about some key areas. I don't want to go over everything. I know you guys already have some familiarity with corporate governance, but what I will talk about is kind of the external auditor, the audit committee, and the internal auditor briefly. All right, so external auditor, right? That's what this course is about. So I want to talk about this arrow here. So in this system, according to this chart, you would think that the external auditors should have their interests should be well aligned with the shareholders' interests because the shareholders are the ones appointing them. Well, it's not really how it works in reality. So in reality, let's say we're in a public company setting, management really is driving that decision to hire or fire auditors. So management decides, hey, we like this auditor, we get along with them, we think they do a good job. Then management is going to recommend that that's the auditor that be hired to the audit committee. The audit committee should be kind of independently looking at the auditor to make sure they're of high quality, but oftentimes in reality, they just kind of end up rubber stamping management's decision to hire or fire there. But in theory, we have this added layer of protection because the audit committee is supposed to be independent, and they're going to decide, look at the auditor's qualifications and make sure they're up to the job, right? Like, are they an expert in our industry, or, things like that? Are they Big Four? Are they appropriately sized for us? Or are we some huge company trying to use a teeny tiny auditor? That wouldn't work so well. So audit committee should be doing all those checks, but they may not necessarily be, right? And the very last step after the audit committee has said, yes, we approve hiring this auditor, this is the auditor we recommend, is the shareholders do technically ratify the auditor through a vote. However, again, this is more like a rubber stamping process where they are automatically said to be okay by the shareholders. Once in a while, if the shareholders are objecting to a lot of stuff at the company, like there's a lot of shareholder action, you might see them reject the auditor, but basically they're just accepting this decision, which has been, recommended to them by the audit committee. So this arrow is in question. Really, it's the audit committee and maybe even management that is appointing the auditor, all right? And the other thing to remember is in a private company, audit committees are not required as of today. So in private company settings, it's still management that gets to hire, fire the auditor. The auditor does report to the audit committee in public company. In private company, if there's no audit committee, they would still be kind of reporting to management or the board or both. So let's talk about the audit committee. So the audit committee, let's go here really quick. Their job is really to oversee and monitor everything relating to financial reporting and everything related to corporate governance in the organization. If you read through this list, you'll see they all kind of fall into these financial reporting or governance type categories. So oversight, monitoring is their big role, and making recommendations. Now, in terms of audit committee membership, well, first of all, audit committees are required now for all publicly traded companies. This was part of Sarbanes-Oxley or SOX. They have to consist of independent outside directors, which means people on the committee shouldn't be affiliated with the company, right? Like the CEO and the CFO and members of the C-suite, employees of the company cannot sit on the audit committee. All right, and though they do receive a fee for being on the audit committee, because the audit committee is a part of the board of directors, the audit committee members do receive a director fee for being on the audit committee, but they shouldn't be also doing like consulting for the company and getting a consulting fee, right? Like they shouldn't be getting fees outside of their normal director fee. Now their normal director fee, if you look, it's disclosed, it has to be disclosed for public companies. If you look, it's often quite substantial and can be a mix of cash and stock. But this could easily be like $100 grand just to sit on a company's audit committee. So it's not insubstantial. All right, and audit committees now, thanks to SOX, at least one member has to have financial expertise. Okay, so what is financial expertise? So financial expertise is based on your education and your work experience. So basically you should have an educational background in accounting so that you can understand GAAP, understand the basics of the financial statements, go read new standards and be able to interpret them and know how they should be used. And typical candidates for this role would be things like retired audit partners, retired CFOs, etc. Okay, so the audit committee, going back to here, right? That's why they're kind of this added layer of protection, because they're composed of these independent members, at least one is a financial expert. So this was kind of a thing before SOX. Again, another problem before SOX is often there'd be no financial experts on the audit committee. And so it would be basically a bunch of non-accounting people looking at financial statements, trying to make judgments about them. All right, we know a lot of these people are experts and they can do it, but it helps to have kind of the background in accounting that even you guys have at this point, right? To understand how debits and credits work, understand how these individual transactions flow into financial statements, understand that the financial statements are mostly comprised of estimates. Just things like that, that basic knowledge is much more helpful when you're interpreting a set of financial statements, trying to figure out if management has done a good job or a bad job. All right, so we have the audit committee here. Remember, their job is to monitor and oversee all things related to financial reporting and corporate governance. Okay, so that's why hopefully the external auditor's reporting to them. They're also getting reports from the internal auditor. So let's talk about internal audit a bit. Right, so the internal auditors should ideally be kind of hired, fired, reporting to the audit committee. Why? Because one of their main jobs is to investigate, we're down here now, investigate management and monitor management, make sure management is adhering to internal controls, make sure management has good tone at the top, all this good stuff. The internal auditor is really responsible for testing, determining if the company is up to snuff, and then reporting that back to the audit committee, right? So we want them to, again, this reporting line directly to the audit committee really provides them with some independence from management. And there are certain rules for the internal auditor, which we'll talk about later, but more in a later chapter, but they should, again, be like independent. You shouldn't be serving two roles in the company, right? Like working as the CFO's secretary and also moonlighting as the company's internal auditor, because these things create conflicts of interest. Okay, so that's internal audits. And now we can move on. So we know we kind of went over this slide already. I would know the items on this slide because sometimes you'll see kind of a CPA question about which of these things are or are not in the audit committee's responsibilities. But I told you the general rule that they're overseeing, monitoring financial reporting stuff and corporate governance stuff. All right, we already talked about audit committee membership rules. And we did already talk about this. Who does the auditor report to? So pre-SOX and still today for private companies, the external audit firm is reporting to senior management. A quick aside for private companies, most large private companies hold themselves to the standard of public companies. And so they will go ahead and voluntarily have an audit committee, but it's not requirement. So in terms of actual regulatory requirements, private companies can still report to senior management, just like public companies did prior to SOX. After SOX, public company auditors are now reporting to the audit committee. So that's why, and we know because the members of the audit committee are financially independent, they have expertise, right? That's a good layer of protection between auditor and management. We also talked about how, really managers still are making hire fire recommendations for auditors, and auditors basically do still have a view that they have to keep management relatively happy in order to keep their job. So these are some required communications for the audit committee to have with the auditor. And it's things like, okay, the auditor needs to be able to convey what exactly their responsibilities are and aren't to the audit committee, but they also will be reporting to the audit committee things like, hey, these are the most significant accounting policies at the firm. These are the most significant judgments and estimates management is making, right? So they'll be pointing out which are the estimates that required the most judgment by management. And the reason why I say they'll be pointing those things out is because the ones that require the most judgment also allow management to use the most personal bias in affecting those estimates. So that's why those are important. They'll also talk about significant audit adjustments. All right, so every audit, you have kind of a running list of places where you disagree with the way management has accounted for something. And some of those things, some of those disagreements, management will agree and they'll go ahead and make an adjusting journal entry to account for that. Other times management completely disagrees with the auditor, and so then that adjustment is never made, right? And the auditor can still give that company a good opinion saying the financial statements are okay, as long as those adjustments fall below what's known as materiality. And we'll talk about this more in chapter 3. But the basic idea here is that, okay, if you're a company of Apple size, right, and you have a $100,000 difference that the auditors found from management, that's not going to make a difference. Like, it's not going to affect anybody's judgments when they're looking at a set of financial statements if something is 100 grand off, if the company is Apple size. Now let's say, all right, they have an adjustment or disagreement with management and some number is off by $10 billion. Okay, yes, this is an adjustment that needs to be made in order for the auditor to be okay with these financial statements and issue a clean opinion over the financial statements. So we'll talk more later about how you make those judgments in both actually chapter 18 and chapter 3. In terms of this slide, what you need to know is the auditor is always communicating to the audit committee about what exactly those adjustments are, where exactly auditor has been disagreeing with management. So what's the importance of good governance to an audit? Well, if a company has good governance, they probably are more likely to have accurate financial statements. They're less likely to have fraud. Management is less likely to be trying to structure transactions to get a certain result in the financial statements. So remember back to like Repo 105 and those bright line rules, they're less likely to be trying tricks like that. So they're generally considered less of an audit risk. And everybody at the organizations taking internal controls seriously, wants to make sure they're effective, wants to make sure that all the transactions are being reflected in the financial statement.